Well, U.S. natural gas futures surged this week to a fresh 35-month high as homes and businesses turned up the heat during a week of extreme cold, while flows to LNG export plants hovered near record levels. Front-month January gas futures on the NYMEX rose more than 4% to $5.28, marking a third straight day on pace for the highest close since December 27, 2022. Yet the rally raises eyebrows. Prices climbed despite forecasts for milder weather next week, slightly lower demand, near-record production, ample gas in storage, and collapsing gas prices in Europe and Asia. For the week, the front-month contract gained about 9%, on track for a seventh consecutive weekly increase, the first time this streak has happened since 2013. Over those 7 weeks, the contract has jumped roughly 75%, a blistering rise that seems disconnected from underlying fundamentals. Weather models suggest temperatures across the U.S. will remain colder than normal through December 12, then mostly near normal from December 14 to 20. While the cold snap offers a short-term boost, the moderation expected mid-month could quickly expose the current price rally as overextended. Analysts estimate U.S. gas output slipped slightly to 109.4 billion cubic feet per day in early December, down from a record 109.6 in November. The high production has allowed energy companies to stockpile more gas than usual, leaving storage about 5% above normal for this time of year. Meanwhile, projected average U.S. gas demand, including exports, is expected to fall from 144.4 billion cubic feet per day this week to 141.4 next week before rebounding to 143.4 billion cubic feet per day in 2 weeks, still not particularly high given the storage cushion. Flows to the 8 large LNG export plants eased slightly to 18.1 billion cubic feet per day so far this month, down from November's record 18.2 billion cubic feet per day. Looking at the supply and demand numbers, it's genuinely difficult to justify this ongoing price surge with a straight face, so I dug a little deeper to see what the bulls might be clinging to. Gas flows to LNG plants have been perfectly steady, almost boringly so, but the weekly data on LNG vessels departing U.S. ports tells a slightly different story. For most of the year, the combined weekly LNG carrying capacity hovered around 110 billion cubic feet. Then, once Plaquemines LNG came online in October, that average nudged up to about 120 billion cubic feet weekly. And yet, despite this additional capacity, the market barely reacted. It was as if traders collectively shrugged and said, "Nice, but not exciting enough." The real spark came when a fresh wave of LNG tankers began pulling away from U.S. ports, driving weekly carrying capacity up to roughly 130 billion cubic feet starting October 29. That, conveniently, aligned with early forecasts of the very cold spell we're living through right now. Suddenly, the narrative became irresistible: more LNG ships leaving, temperatures dropping, and, voila, the perfect excuse for bulls to pound the buy button as if fundamentals had magically transformed overnight. And the final push came from a late surge of 37 LNG vessels, carrying a combined 138 billion cubic feet, that departed U.S. ports between November 27 and December 3, a week in which Plaquemines once again asserted its growing influence. Of course, none of this changes the reality that supply continues to outpace the incremental demand from LNG, and is expected to keep doing so well into the middle of next year. But why let that get in the way of a good old-fashioned rally? When traders smell a story, they run with it, even if the math is standing off to the side, rolling its eyes. Well, let me know in the comments if you'd like me to keep tracking LNG carrying capacity in the weekly outlooks. And if you want to stay in the loop when new updates drop, make sure to subscribe so you don't miss a thing. Globally, gas prices tell a different story. Dutch TTF prices plunged to a 23-month low near $9 amid hopes that peace talks over Ukraine could ease sanctions on Moscow, potentially allowing Russia, now the world's second-largest gas producer, to export more. In Asia, the JKM benchmark slid to an 18-month low around $11. Meanwhile, U.S. prices continue to climb, leaving some to question whether domestic futures are increasingly driven by speculation rather than fundamentals. Seems like someone's gambling on the U.S. market, hoping to cash in before the inevitable price correction hits. I'd like to point out that, historically, the $3 level has tended to represent the average price for the U.S. natural gas market. This is largely because most domestic gas producers begin to generate meaningful profits once prices reach roughly $2 to $2.70. In other words, $3 isn't just a round number, it reflects a point where production economics and market balance have historically aligned, making it a key reference for both traders and analysts. Moreover, some producers continue to profit even when natural gas prices turn negative, because for them gas is essentially a byproduct of oil extraction rather than the primary revenue source. This dynamic applies to roughly 30% of total U.S. gas production. As a result, there is an inherent tendency for the U.S. natural gas market to lean toward the bearish side, since a significant portion of supply can remain economically viable even at very low, or even negative, prices. Natural gas has been behaving like a textbook breakout across practically every timeframe, but the almost straight-up vertical surge, and the increasingly overbought signals flashing everywhere, significantly raise the odds of a near-term pullback or a period of cooling off. If prices manage to defend $4.80, and especially $4.60 during any retreat, the broader uptrend keeps its grip on the market, with $5.70 standing out as the next logical upside target. But if $4.60 gives way in a sustained fashion, that's when the caution flags finally start to matter. If you enjoyed the video, drop a comment, hit like and consider supporting the channel, it really helps keep things moving.